Hi everyone, welcome to my channel, The Young Analyst. I'm someone who enjoys doing stock research and have my own small portfolio. I thought I would start this channel to share my opinions and get ideas from similar like-minded people, so feel free to leave your comments about my analysis down below in the chat box. Today we'll be discussing the Chinese logistics sector, which has undoubtedly been accelerated by the COVID-19 pandemic, with two main key messages in mind: why you should consider investing in this sector, and my personal best picks in the sector. Therefore, please stay tuned to the end of the video to find out which stocks I'll pick in this sector. As a disclaimer, none of the things that I say in this video is to be constituted as investment advice, and you're encouraged to do your own research before investing. As a broad overview of the sector, Chinese logistics stocks generally operate in two main buckets: those that solely do express delivery, and the second one will be integrated logistics services providers. The former mostly consists of stocks like ZTO, Yunda, YTO, Best, STO, while the latter consists of SF Holdings and JD Logistics. Express delivery is a well-defined sector that is driven by the provision of e-commerce delivery activities. This sector is highly competitive on pricing as it offers a commoditized product, with economies of scale being the keys to success. On the other hand, integrated logistic players are those that offer a broad range of capabilities, including supply chain management, cold chain and pharma transportation, freight services on top of express delivery. Why should you invest in Chinese logistics? Firstly, there is room for further growth when benchmarked to a mature market like Japan. According to Bloomberg Intelligence, China's average of 59 parcels shipped per capita in 2020 sits well below Japan's 71 parcels per capita. Parcel growth is far from plateauing given the fact that much of the country remains underpenetrated. There is a huge disparity between its 31 provinces and municipalities, with 24 of them below the national average and 10 regions shipping less than 15 parcels per capita. In fact, the number of parcels per capita is likely to exceed Japan's number, given several areas like Zhejiang, Guangdong, Shanghai and Beijing shipped over 100 parcels per capita in 2020. One key driver that will underpin this trend will be e-commerce growth. According to Bloomberg Intelligence, the average number of parcels shipped per capita in China could rise to 76 this year, as new e-commerce models such as community group buying and live streaming drive sustained online retail sales growth. This implies a 30% parcel volume growth in 2021, assuming only a slight slowdown in annual growth CAGR of 42% from 2009 to 2019 and 32% from 2016 to 2019. As you can see in the graph on the bottom right, despite China returning to normal in 2021, online retail sales have continued to post a year-on-year increase. In my personal opinion, at least a 15 to 20% CAGR in parcel growth should be supported in the next few years, fueled by a sustainable change in consumer buying habits post-COVID-19. The second good reason to invest in Chinese logistics is that stocks have fallen off their all-time highs due to intense price competition as the industry consolidates. As you can see in the four graphs here, SF Holding posted the largest drop in the last 6 months of almost about 50%. ZTO slid down by 30%, while Yunda and YTO corrected by about 20 to 25%. As you can see, ASP change over the past year has been negative, even as volume growth remains positive. Note that the bulk of express delivery players operate at ridiculously low price points of RMB $2 per parcel, with the exception of Shunfeng, which is SF, which offers premium deliveries at a significantly higher price point, an advantage that only SF is able to command. However, SF's prices are not immune to the ongoing price war amongst other express firms. Even though a consultation paper released by the State Administration for Market Regulation in early July stated that dumping products will be subject to heavy fines, suggesting that parcel ASP will be stabilized in future and the pace of industry consolidation may slow down, the industry is likely to continue to shrink to a handful of leading players. Therefore, it is important to pick the winners in the industry. My top picks for this industry are ZTO, which is a leader in express delivery, and SF, which is a leader in integrated supply chain services as it operates across multiple areas including express delivery, freight, cold chain, etc. ZTO is the market leader in express delivery with about 20% market share, and its market share has been on a continuous upward trend. Peers have a combined 49% market share between them. Its unit economics are the most superior amongst its peers. Morgan Stanley estimates suggest that as of first quarter 2021, ZTO's unit profit was the highest amongst its peers, and given that its ASP was the lowest in the previous slide that I had shown, it shows the magnitude of ZTO's cost advantage. This has allowed ZTO to post a positive operating cash flow in first quarter 2021, even as its peers remain in the red. ZTO's cost advantage is significant as it allows the company to continuously invest in capex to gain incremental volume of the industry. This is critical to success as you can see that the market share of players is directly correlated to average capex spend for the past 3 years. For SF, the first reason I'll invest in this stock is that it has the strongest logistics infrastructure network in the country, allowing it to provide a one-stop logistics service for its customers. Comparing SF and JD Logistics, it is apparent that SF has a much wider and deeper coverage in terms of line haul and last mile capabilities. One special point to note is that it has extensive aviation coverage, which allows it to do premium deliveries that are time sensitive, enabling SF to charge a significantly higher price point that I had mentioned previously. This is a competitive advantage that is rare in the industry so far. I also like how SF continues to ramp up its competitiveness in new business segments such as freight, cold chain, pharmaceutical, supply chain solutions, and so on. New businesses reported a 51% increase in revenue in 2020, contributing 28.2% of total revenue. SF has a good track record of making complementary acquisitions to bolster its capabilities in new segments, having acquired the China businesses of Harvey and DHL, and its acquisition of Carry Logistics is expected to close by the end of this year. Once completed, the deal would significantly enhance SF's advantages in cross-border logistics by adding critical capabilities such as freight forwarding and customs clearing. These new businesses will be core growth engines in the future, underpinning SF's solid earnings potential. I've extracted broker consensus on revenue growth and margins till 2023 from Bloomberg, and this data is as of 20th August. As one can see, ZTO has superior margins compared to its peers. SF's margins are low because they are dragged down by loss-making segments like freight and intracity. Over the mid to long term, SF should be able to reduce losses from some of these new businesses. Management has also mentioned plans to spin off its intracity segment, which can unlock value for shareholders. In terms of overall EPS growth from 2021 to 2023, SF and ZTO have the most superior EPS growth prospects. ZTO's share price underperformed since late March this year on its 4Q 2020 results miss and weakens earnings growth outlook. Year to date, ZTO underperformed, mainly reflecting market concern at slower than expected volume growth and market share gains. ZTO is currently trading at about a 3-year forward PE mean of 25 times. And this is roughly in line with Yunda's FY22E PE multiple and is lower than the average of Yunda, YTO and STO multiples. However, I think that ZTO still deserves a valuation premium to its A-share listed peers given its better fundamentals. Therefore, the attractive valuation at this point represents an opportunity to accumulate small volumes of the stock. SF is currently trading at 41 times on a forward PE basis, which is just above its 3-year mean of 26 times. SF deserves a valuation premium over its Tongda peers as its investment will differentiate its earnings potential in the longer term. This present level of valuation also presents an opportunity to accumulate small portions of the stock. Given that there are potential regulatory headwinds on the horizon surrounding the Chinese logistics industry, such as the social welfare regulations, I'll wait for more clarity before accumulating larger volumes. With that, I've come to the end of my sharing today. If you're interested in a full-length analysis of SF or CTO, please leave a comment in the chat box down below. See you next week.